if 401ks, IRAs, 403Bs, and Roths sounds like alphabet soup, today's video is for you. I've been a fee-only financial advisor for over 20 years, and I've guided hundreds of people through the foundations of the retirement planning tools, and that's what today's video is all about. Giving you the basics and helping you understand the building blocks of anybody's retirement planning. So let's go for a walk and talk about this. And let's start with one of America's favorite retirement planning tools, retirement savings tools, and that's the 401k. And a 401k is an account that's offered by your employer. And often the employer will offer you a match. Basically, if you put in a couple percent, the employer will match that money. And it's typically they'll match 2%, 3%, 4%. Some companies are more generous than that, but that covers the vast majority of companies. And you know, if you have access to a 401k and you think you're going to be at the company for a couple years, it's probably worthwhile for you to consider doing it, because when your employer matches that money, that's basically 100% return on your money. And there's not many opportunities in investing to get 100% risk-free return. Now, there's got to be a little asterisk next to the risk-free, because very often there's a vesting schedule, typically 4 or 5 years, that you have to stay with the company until you get the employer's money that they contributed. Now, importantly, your money is always yours, 100%. And these accounts are regulated by the Department of Labor, which is a U.S. government agency. So you don't have to worry about getting screwed out of your money, right? No employer wants to run afoul with the Department of Labor. So that's the 401k. It's got an unusual name. Same thing with the 403b. And it's just the tax code that permits these accounts and or the IRS code. So as long as we're talking about it, let's talk about a 403b. And you know, the nice thing about a 403b is it's essentially a 401k, but for a not-for-profit. Okay, so high level, they're very, very similar. There are some differences. In a 403b, if you've been in your company over 15 years, you can typically contribute a little bit more than the numbers I'm going to share with you. But that's the basic of what a 401k is. That's the basic of what a 403b is. It's just a special account that the government gives preferential treatment to from a tax standpoint. Now, you put your money in pre-tax dollars. And because you're putting in your money in pre-tax dollars, it's as if you never earned that money. So you're not paying ordinary income tax on that money. So let's say that you earned in a year $50,000 and you put $5,000 in your 401k. Now, I'm not an accountant, and you want to talk to an accountant on this. And this is really for educational purposes, to get you to look things up yourself and give you a place to start. But essentially, on that $50,000 that you earned, if you put $5,000 in a traditional 401k, a traditional 403b, it's as if you only earned $45,000. So I hope that makes sense. The contribution limits, as I record this in 2023, you're limited to putting in the amount of money that you earn, or, and it's the lesser of, or $22,500. And if you're over 50, over 50, there is a $7,500 a year catch up. So if you're over 50, you can actually put $30,000 in. So that's the basics of the 401k. That's the basics of the 403b. Now, let's move on to an IRA. So an IRA is similar in that you can put pre-tax dollars in, but the difference, remember how I said a 401k is offered by your employer? An IRA is an account that you'll set up at a custodian like Schwab or like Fidelity, and you own that account. Your employer doesn't own that account. Now, I want to stress again that with a 401k and a 403b, your money, the money you put in, the earnings on your money is your money, even though it's an account that's set up with your employer. Okay, so an IRA It stands for individual retirement account. And again, you're putting money in pre-tax dollars. It's going to grow tax-free. And when you take the money out, because you put money in without paying taxes on it, right, in pre-tax dollars, it grew tax-free. So when you take the money out, it's literally time to pay the piper. It's time to pay the government their taxes. So every dollar you take out of a regular IRA is going to be taxed as ordinary income, as if you earned it. Hopefully that makes sense. Now, the limits on an IRA, as I record this in 2023, is $6,500 a year. And there's a $1,000 a year additional opportunity to put in money. It's called a catch-up provision for people that are 50 years old or 50 or older. So if you're 53, you could put in $7,500. Now, unlike a 401k, there is an income limitation on whether you can put money into a 401k. And again, into an IRA. And again, you want to look this up yourself, but in 2023, the modified adjusted gross income, what we call MAGI, if you're single, so this is your essentially your wages. If you're single and you earned under $153,000 and you're filing single on your tax returns, then you qualify, $153,000. Now it scales out. Again, this is just something to get you going on your own research. And if you're filing if you're married and you're filing jointly, the limitation is $228,000 between you and your spouse in that situation. So hopefully that makes sense. Again, the limit, it's quite a bit lower, right? It's harder to put money into an IRA. Okay, now I want to talk about Roths. And basically what Roth does now, you need to, the reason I went through the IRAs and the 401ks first, and I talked about them as regular 401ks and regular IRAs, there's also Roth versions of those accounts. And with the Roth version of those accounts, you put money in after-tax dollars. But the nice thing is then, just like with a regular account, the earnings grow tax-free. But very differently, when you take money out of the account, it is not taxed as ordinary income because you paid the tax on the way in. So that's kind of the basics for the Roth. And the Secure Act 2.0 that was passed in December of 2022 allowed for your employer to put money into a Roth 401k or a regular 401k for you. So you get to decide that. And starting in 2024, if you're making more than, I believe the number's $145,000 a year, the employer contribution has to go into the Roth portion of the 401k. The additional, there's an additional piece that the employer's money has to go in too. So you want to look that up yourself, but know that some of the money has to go into the Roth version of the 401k. But that's more of a detail. So I want to wrap it up here. Hopefully you found this useful. If you did, you'll enjoy this video up here that talks about 8 things to stop doing as you approach 65 years old. And this video down here that talks about 5 reasons to retire as soon as you can. Thanks for watching. Bye-bye.